This is Super Investors and the Art of Worldly Wisdom. I'm Jesse Felder.
Object to the test!
This show is brought to you by the Felder Report. When I'm not interviewing one of the most interesting minds in the world of finance, I'm doing a ton of reading and research, and I put together some of the best things I find each week into a free Saturday morning email. If you're interested in getting it, just go to thefelderreport.com and click Join Now right there on the homepage, and you'll be good to go. Variant Perception is an investment research firm founded on the idea that man plus machine beats machine or man alone. In an era dominated by passive investing and other purely quantitative strategies with relatively short look-back periods on the one hand, or rampant speculation in meme stocks and other moonshots on the other, nothing could be more contrarian and perhaps more valuable than taking a more thoughtful approach grounded in historical context and driven by tactical tools that have proven valuable through many market cycles. This is precisely the focus of Variant Perception and its CEO, Tian Yang. In this episode, Tian discusses the details of his firm's unique investment analysis framework, and given the apparent paradigm shifts already underway, how it is especially valuable in assessing markets and the economy today. So please enjoy my conversation with Tian Yang.
You ever wonder why fund managers can't beat the S&P 500? Because they're sheep. And sheep get slaughtered.
Tian, welcome to the show.
Glad to be here.
You know, I'm excited to do this. This is something I've wanted to do since I interviewed Jonathan Tepper. I think it was almost 4 years ago. It's hard to believe, but I've been a big fan of Variant Perception for a long time, and I'm glad to just be able to have this time to really explore what you guys do. You have an especially interesting framework that's relevant to the current market environment. But before we dig into that, I'm curious to know a little bit more about you and your personal story, Tian. How did you first get interested in finance and markets?
Well, funny enough, obviously you mentioned Jonathan. I had actually read some of Jonathan's best-selling books when I was still at university. So, things like Endgame, Code Red, obviously came out a bit later. So, that was kind of the very original starting point. And after that, went into do derivatives trading at Merrill Lynch. I think it was interesting, but I think given all the regulatory constraints at the time, it was kind of a shifting industry. And, the opportunity came up to work with Jonathan in 2014, and I essentially just jumped at it. So, it all kind of ties back to him, really.
And so was it reading his books that was the thing that really kind of sucked you in? Or was there something else, earlier on maybe that, that kind of drew you to investing in markets? I did study economics at Cambridge, although I think when I first got into it, I was very much interested on the development side and development economics and the like. And but when some of these universities, they tend to be targeted by the investment banks and the investment companies for recruitment. So I remember in the first year, a friend of mine asked me to go along. We did some of these trading simulation games, did some of these M&A simulation games, and we ended up winning a lot of these games. And then off the back of that, got to go to London, go to the head offices, and you get internships on the back of these events. So that was kind of the original thing that I think that pulled me in. It was very interesting to kind of participate, in a lot of these kind of practical, I guess you would call it workshops, right, or student sessions. So I think that was a starting point. And obviously start to try and read a bit more widely. I think it was a pre-FinTwit day, so there weren't that many blogs and things around like there is today. But so you had to probably look a bit harder for information. And so that was kind of how I found Jonathan's books, actually. Well, that's funny that that it was kind of simulations and games. I'm older than you are, and when I was a kid, my dad bought one of the first Apple computers, Apple IIe. I think this was in the early '80s. And he got a couple of games for it. There, one was called Millionaire, and it was a stock market simulator, the most boring video game you could ever imagine in your life. It was such a terrible game. But I played it, and I was like 8 or 10 years old, and I got super interested in the stock market. And it's interesting how
gaming. It can just kind of get you I get fired up about a lot of this stuff. The name Variant Perception, I love the name. In one of your recent pieces, you reference a Jeremy Grantham quote, market timing is a tag some buy and hold investors use to put down anything that involves using your brain. With passive investing dominating the markets today, taking a thoughtful, active approach is about as variant as it gets, right? I mean...
Yeah, absolutely. I think it's a little bit like Buffett says, most of the time the market probably, is somewhat efficient, but that doesn't mean, there's an opportunity. And I think a lot of the times, if you're not focused on looking for the opportunities and reacting, then obviously, it's going to slip you by. So, in terms of what we do at Variant, we essentially try to take a, very kind of empirical, data-driven approach to screen for these opportunities as and when they come about. And, given that opportunities don't come along that often for us, I think it's more about just having a very broad range of tools and indicators that are looking across, different time horizons, from tactical kind of 1 to 3 months trading, right through to lead indicators for kind of the 6 to 12 month business cycle, all the way up to kind of capital cycle, demographics, debt and currency cycles that tend to be more, 2 to 3 year plus structural views. And so, in terms of how we think about the world, it's very much about trying to combine together our mix of indicators across very, very different aspects of investing. And, once you build enough of these models and have enough of these indicators, you end up with, a pretty rare, I think, mix of indicators. And sometimes things just align and big themes come up, things like the quantity super cycle. A lot of these things tend to be when suddenly everything aligns, and then the opportunity comes. But, a lot of times, obviously, it's not as clear cut. So, clearly, I understand why passive is big, but, it's probably not as simple as just forget about it.
Right. Well, it reminds me of, I'm glad you brought up Buffett, because one of my favorite Buffett quotes, it's from decades ago. I think this was another quote from the 80s, where he was writing about the efficient market hypothesis, and he asked, quote, what could be more advantageous in an intellectual contest than to have opponents who have been taught that thinking is a waste of energy, end quote. And so I think today with the majority of the market, almost everybody operating as if thinking is a waste of energy, there's a huge opportunity for thinking investors. And so, to me, it's fascinating to see how you guys are approaching this. Let's start to dig into some of the stuff. You guys are focused on everything from tactical trading to cyclical and structural analysis. Can you walk me through how you approach maybe each of these timeframes and how they fit together into a larger framework?
Yeah, sure. So, the 10-second summary in terms of our research philosophy is this idea of man plus machine beats machine. We live in a world where increasingly there's a lot more computing power, a lot more data. There's a lot of advances in signal processing, machine learning, and so forth. So, there's a lot of new opportunities that are appearing. And so, that obviously increases the potential of what small teams with access to good data can build out. But at the same time, I think that the DNA of the firm and the history of the firm has always been embedded in being students of economic history, studying kind of various historical periods and looking for analogies and lessons to be learned. So essentially, when you can combine the two, they kind of make up for the shortcomings of each approach. If you're just a pure quant machine learning, you just take all the data and, essentially optimize, you might be missing regime shifts, you might be missing something, you might be overfitting your model. Big regime shifts happen, right? Some of it might not be in the data. But equally, obviously, if you're purely, taking more of a kind of non-quant approach, then it's probably sometimes quite hard to control for, internal biases and things like that. So I think by taking this man plus machine idea, it kind of hopefully makes up for kind of the worst kind of issues of either approach, and then putting them together gives you more of a balanced view and helps you really figure out when everything's aligned. So to that end, you can apply the same ideas to not only big picture, what people traditionally think of as macro, right? These big macro cycles, a lot of these debates about the dollar and so forth, you can obviously apply to the big picture. But even in terms of business cycles and trading, there's a similar approach because, a lot of times if you just data mine for something, it might work, but, is it intuitive? Does it make economic sense? And is that kind of like a fundamental kind of mechanical process that results in it working repeatedly over time? So the classic examples we always give is, when you're looking at the economy and the business cycle, it's very, very important to focus on what are leading parts of the economy rather than pay attention to, data like GDP or, employment numbers or any of these things that typically make the financial news. Just because, if you think about how things fundamentally work, there's always a sequence in which things should happen. Things like building permits should always have a turning point before construction activity starts. Companies typically don't lay off workers at the first sign of trouble, right? The first adjustment they might do is with their temp workers, and then eventually, if things get so bad, they might start laying off permanent workers. So, this kind of leading lagging idea exists across lots of bits of the economy. So often, it probably does take a little bit of thinking, the man part first to try and understand fundamentally how things work and the linkages. And then once you have that, you can then zone in on hopefully a superior set of data inputs. Then you can apply all your kind of statistical techniques or quant techniques to come up with a better model. In a way, it's almost like starting with a prior for how that works, right? That's strongly driven by kind of more manual work. And then once you have that prior, to use the kind of more quant approaches to kind of update that over time.
Interesting, and I want to dig into kind of each of these time frames because I find that you mentioned FinTwit, and one of the things I think on Twitter is maybe the biggest waste of time is you have somebody who's a tactical trader arguing with somebody who's more focused on the business cycle, and like you guys could both be right. It doesn't just you're focused on different time frames and different things. So I think being sure that you understand, and appreciate which of these kind of things you're focused on, structural versus cyclical versus tactical, I think is critical. But let's kind of dig into the tactical side of things for a minute, because I appreciate the fact that you have so many interesting indicators on this level, because I think most people appreciate that we're in a bear market, but sentiment, back in June got so negative that the setup for a tradable rally was getting very strong. And so and I know you guys were appreciative of that. How do you guys approach the tactical side of things? I know you focus on trend and sentiment and even historical price analogs. Can you share some of the kind of the details of the components there?
Yeah, sure. So, in a nutshell, there's two frameworks we use for tactical trading. So one is essentially the 1-0 buy sell signals. So they are obviously very specific kind of events with set triggers that go off. So they're kind of, the alerts, if you like. And then we have something, what we would call a tactical context. So this is where the sentiment trend and the analogs come in. So they're kind of indicators you can generate a number for every day. And they're essentially like a percentile approach to give you a sense of what the forward projected return is, given, the current readings for sentiment, trend, and analogs. So trend is kind of the more obvious one, right? Where ultimately the price, whether it's going up and down, there's different ways to define it, but usually it's fairly easy. People can use moving averages or new highs, right? I remember reading like a very famous quant book on trend following. Ultimately, when you do the back test, is the simplest way of defining it, which was like a 30-day or 90-day new high, ended up being one of the best performing things for trend. So, trend's probably the easiest one. It doesn't matter too much how you define it.
Right.
Sentiment's a bit trickier because obviously most people are judging sentiment by looking at surveys and the like. One approach we've taken is was somewhat inspired by kind of the original Kahneman work on how people experience loss aversion. And his key point was that essentially at the end, what you remember is kind of the peak emotion in the middle, and then obviously the end result. So obviously, as it applies to an investor or trader, it's the return you made at the end, but also how much did you give up in the middle, or did you experience a big drawdown? Because obviously, if you made zero at the end of the period, but you survived a huge drawdown and came back, you probably feel a lot better than if, it was a zero, but, you were up 100% and now you're back to flat. So, that's one of the ways we track sentiment, by tracking kind of the end period return over the max favorable move in the middle and the max kind of drawdown in the middle, and just applying it over different kind of trading periods. That can, at least that's one way to quantify it. Something else we do is we're extracting kind of implied sentiment data by looking at option markets. So things like skew, term structure, looking at the price of kind of, digital options, that price crashes. So again, that's a more quantifiable way to at least get a sense of sentiment to allow you to compare. And then finally, on the analog thing, I think the slightly better innovation I think we're doing is we're not just data mining in terms of the exact same price patterns versus history. I think a big problem with technical analysis is that things tend to happen at different speeds. But when we go on Bloomberg or Google Finance or whatever, and we pull up a price chart, obviously the time axis is usually fixed, right? You're forced to do analysis in fixed units of time, and so you can apply some newer techniques from signal processing, things like dynamic time warp and the like, to give you a lot more flexibility in terms of your time horizon, to look for similar kind of sequencing rather than exactly the same shape. And so this gives you kind of much better historical analogs for price actions, rather than just being a simple kind of straight kind of a pattern fit. So that's kind of the innovation, where by doing a time warp, you can hopefully find slightly better historical analogies, and then you can use that to kind of find what the expected forward return is based on the historical patterns analyzed. It's actually pretty cool, right? It's kind of a similar algorithm that people use in speech recognition. So when you talk to Siri, we'll have different accents, speak at different speeds, right? So essentially what Siri ultimately has to do is take the different kind of patterns of sound waves, but essentially use this algorithm to figure out if ultimately it's the same kind of sound wave, right? And it'll recognize it. And so, obviously you can apply this to financial markets as well. I think we originally started doing this because we wanted to actually backtest different technical analysis patterns to see if they actually were statistically meaningful. Unfortunately, I think once you try them on a broad enough series of stocks and prices, it's not statistically meaningful for a lot of common patterns. But by trying the technique, I think we found it's actually not bad as for finding analogs, because obviously when you look for analogs, you can also have a measure of fit. And surprisingly, if you get a really, really good measure of fit, you can obviously go back and have a look at the kind of macro historical context, and that often gives you a lot of pretty good clues for kind of how things might play out. What are the signposts look for kind of today? So hopefully that gives you a sense of how we think about kind of trend, sentiment, and analogs.
Yeah, I'm especially curious to hear you discuss the price analogs, because I know it's something that it can be heavily criticized by non-active investors. But I've always been curious about price analogs, especially when they have when they rhyme with history, not just in terms of price, but in terms of the economic background or whatever, because I think it's something that has been a very key component to some of the most successful hedge fund managers out there. I mean, obviously, Paul Tudor Jones famously profited from the '87 crash by using the 1929 price analog. I've talked with Tom DeMark about this, who integrates price analogs into his work when he's was working with Steve Cohen and some of the most successful hedge funds on the planet. And price analogs get a really bad rap, but I think if you're not just using them as a pure hey, market did this, whatever it is 40 years ago in isolation, and saying I expect it to do exactly this in the future, you're using it in a more thoughtful way, I think it can have terrific value.
Yeah, I mean, absolutely. And as you said, again, the key is to apply it in a more broad sense, so you end up it's kind of the mosaic, right? And you end up actually building a good picture. So we also apply the technique to find the appropriate macro kind of historical context. So, and this was essentially how we found a historical roadmap early in the year for how this year would play out, which we said was essentially like 1984, which was kind of the last time you had bonds and equities crash at the same time. That was like still the Volcker Fed. He did like a big front-loaded 100-bip hike at the time. There were concerns about inflation coming back. Even though Volcker originally broke the back of inflation in the 70s, it was starting to tick higher. Growth was slowing down. And, so it's actually pretty helpful that when you run all this, it can give you a historical period and you can go and actually do some and look into it, right? And so that's what we did. And you end up seeing these really interesting articles at the time as well. Very similar to today, right? I think, I remember there was some Washington Post articles talking about where again, Volcker was just like, we're going to keep hiking until it's done. And then there was some op-ed pieces talking about, that the central banks need to like intervene essentially to save equity. Like, they didn't call it a Fed put back then, but you can see the similar sentiments.
Yeah.
So yeah, I think it's it can be pretty interesting as kind of one of the kind of more advanced techniques to try and improve on some of these processes people have been doing for a while to find good kind of historical analogies.
Right.
And by the way, just on your the Mark point, actually, I think we're definitely big fans. His stuff actually works, at least in the testing I've done, I think works pretty well. And that would obviously fit into kind of the 1-0 bucket of tactical trading we talked about a bit earlier. And and again, you talked about analogies, the 87 crash similar to 1929. I think something that's influenced a lot in this kind of area was actually the work of Didier Sonnet. I think I've mentioned it maybe, in a lot of our work, in recent years as well, where he essentially, again, realized that there was a lot of these common patterns to how market crashes happen. And he essentially developed this, LPPL, log periodic power laws, kind of trading system, if you like, to look for, situations where potentially price action suggests there's a regime shift coming with a big price crash coming. So, that's something where we've spent a lot of time digging into kind of how to make LPPL more practical and useful. And funnily enough, what we found was it tends to line up a lot with when the mark signals go off. So it's fun. So it's really interesting you mentioned, because, with the analogy, with the DeMark signal, ultimately it ends up being the same thing, which is that there's if you can find certain patterns of social behavior that warn of potential crashes, then it can be a very, very powerful thing. And indeed, I think this year, it's held us in really good stead, right? The LPPL predicted kind of the tech crash on January 11th when the model started triggering, predicted another leg of the bond crash at the beginning of April. So, it's just looking for these patterns of social behavior that essentially is, the kind of thing you would see, before earthquakes, right? Before kind of stampedes, if you look at the kind of the ideas that originally inspired Sonnet to come up with this. So there's a signature,
that kind of triggers ahead of a lot of them. And I think the point is that each of these things in isolation has less value than when you kind of put them together and synthesize them into something bigger and more valuable. On the cyclical side of things, one of the big, let's kind of take a look at how you guys approach your analysis of the business cycle and things. One of the big debates, obviously, right now is about the prospect of recession. How do you begin to assess possibility of economic downturn? How does your framework, I guess, approach this issue?
So again, I think we basically do two approaches at the same time. One is what I would call a quadrant approach, for lack of a better word, right? It's this idea the world is somewhat continuous, so things speed up, they slow down, you go into a recession recovery, right? I think that's probably more the world we are traditionally used to thinking about when people think of business cycles. And then alongside that, we have essentially a 1-0 regime shift where things are modeled as a jump process. And so the way we look at it is we have kind of liquidity and growth lead indicators that operate according to this quadrant idea. So you're getting a sense of whether things are speeding up or slowing down in terms of growth lead indicators, in terms of liquidity lead indicators. But then you also have these 1-0 regime shifts that ultimately, to us, what recessions are about. Recessions are, you shouldn't really be that worried if it's like just a pure technical recession where GDP is, minus 0.1 for 2 quarters in a row, right? Like that's not really going to break things. The recessions to be worried about are the more broad-based recessions where multiple parts of the economy are slowing down at the same time. they start a feedback loop into each other, which then in turn feeds into kind of financial markets, the soft data feed into sentiment, which in turn then feeds back into kind of the hard data, and companies start seeing smaller revenues and they have to actually lay off workers, who in turn obviously then feel bad and then spend less, right? Those are the cascade self-reinforcing recessions that it's very hard to get out from. So, those are the things we're trying to watch out for. So for us, we do some Bayesian updating models to try and kind of forecast these jump processes. So, each month we'll calculate a probability that this particular month will be judged to be essentially a broad-based recession as the NBER would define it. And, and so we would operate that alongside the kind of growth and liquidity LEIs. So, and obviously we're recording this in September. So, right now, both the growth and the liquidity lead indicators are extremely bad. They've basically been bad for the whole of this year. But in terms of our US recession model, it hasn't quite jumped yet, right? So the risk is probably around 20 to 30%, depending on what day you look at it, but it's kind of not over the threshold. So that gives you kind of a sense of how we think about it. On our models, we think Europe and China basically in kind of recessionary territory. China basically for the whole of this year already, and Europe, from March, April onwards. So we'll see if it proves to be true. I think the key thing to mention is in real time, the analysis of this is very difficult because so much economic data is revised, often very heavily. So most actually, I think it's fair to say most kind of macroeconomic data releases are not that useful when you see the first release. Right, we know things get revised, but in particular turning points, they get revised potentially a lot and up to kind of 3+ months later. So I think it's very, very important to actually use inputs that are minimally revised or not revised at all, which will give you kind of a much cleaner a picture of what's going on. So yeah, live example today would be something like the labor markets, right? There's so much attention paid to, what's non-farm payrolls, employment. But the reality is, if you look historically at these data series going to recessions, they tend to be very heavily revised because, it's not that real time, right? If companies have to report the employment every month, there's a delay to the data getting reported. There's issues with collecting the survey. There's double counting, and so yeah, I think that's something very important to emphasize as well. Actually doing the work to figure out what data series are useful and what isn't, and having done that, there's huge swaths of economic data that we don't even touch that fills most of the news, or things or charts you see on Twitter that, to us, I think they're helpful to gain an understanding ex post of what's happening. But again, in real time, you've got to be very careful.
Yeah, I'm really glad you brought that up because so many people say, well, the labor market is so strong, there's no way we could be headed into recession. But I think in one of your monthly or quarterly updates, you pointed out that, look back at, 2007, the real time data said, labor market was still very strong and all these things, but then they revised it, well after the fact so that, the numbers we look at now look like, oh yeah, it was pretty obvious that recession was coming, but in real time, it wasn't so obvious.
Yeah, I mean, the classic one is officially U.S. recessions are dated by the NBER. But this can take up to a year, right, or more in the future. But again, if you're not familiar and you sit down and just go on Bloomberg and download the time series, it looks like, oh, this is great as a signal.
Yeah.
When I gotta be, get bearish. But again, in real time, you're not going to get that data until well after the fact.
Well, and I'm kind of skipping ahead before I want to. I mean, you have this great stock market bottom checklist, and one of the things on the checklist is recession is already obvious. It's already kind of been obvious to everybody. By the time that happens, the stock market's bottoming, right? And I think a lot of people, have say to me, and it's typically retail investors and things, they say, well, why not just wait until recession to get tactically more conservative? Well, that's the time to get tactically bullish, right?
Yeah. I mean, that's there's no two ways around it. But
yeah.
that's what they're saying. It was, I can't remember who. I think maybe it was Schwartzman or someone. The quote about there's kind of aggressive. What's the word? they're brave investors or they're old investors, but they're not brave old investors.
Exactly.
Yeah, I think if you go through one cycle, the next time around you'll probably be a lot more cautious.
Yeah. We're recording today on CPI Day. I'm going to publish this to try and get it out tomorrow. But with CPI report out, aside from recession, another major debate centers on inflation. Markets have been pricing in a very rapid decline in inflation over the next 12, 24 months. You guys have been suggesting that rather than a peak and rapid rollover in inflation, we're more likely to see a plateau. Why? Well, I mean, what are the indicators that you guys use to kind of assess this?
So inflation in general is one of the most lagging economic indicators. So again, in a normal cycle, even things like coincident growth will tend to give you a pretty good clue on inflation. I think the difficult thing this time around is there is a lot of one-offs that are distorting the data quite heavily. Obviously, we're aware, right, that the thesis is essentially, everyone on Team Transitory is just focusing heavily on things like supply chain disruptions that will normalize, COVID policy things that will normalize. Whereas I think people on the kind of more persistent inflation are very focused on some of the structural factors, end of deglobalization, labor shortage potentially coming up, wage price spiral, and so forth. To us, I think, again, it goes back to the time horizon that matters. The most predictive horizon is probably 6 to 12 months out. And there, things like, you can use inputs like ISM prices paid, and the like. You can use things like actually employment data, for example. So like temporary employment data, for example, that gives you a pretty good lead. You can use things like credit growth. They tend to actually be a reasonable proxy for where inflation is potentially going. So in a normal cycle, these models tend to work well because in the normal cycle, you just have to mostly capture the changes in demand, and that'll give you a pretty good sense of inflation. The challenge right now is, I think, on the supply side, it's actually getting a lot harder to model because of all these shifts in kind of the geopolitical environment, shifts to supply chains. And these things are, I think it's pretty naive to assume they're going to go back to normal quickly. And so right now, because of that, even if you perfectly capture the demand side, the supply side is going to be more problematic. And I think that's probably where a lot of the kind of at least divergences in market views are coming from. If you only look at a lot of the demand side proxies, things probably do look like they're going to roll over quite hard. I think for us, our judgment would be that the supply side problems are probably not as easy to resolve as you think. It takes a long time to reorient supply chains properly. And, and obviously I mentioned, we have the whole commodity super cycle thesis, which is heavily predicated on supply. Ultimately, we live in a world that, even before the Russia-Ukraine disruption, we lacked energy, right? There wasn't enough food. There was all sorts of potential issues, capital scarcity that was going to come anyway. And now you've kind of, in addition to that kind of structural solvency issue, you've injected this huge, if you like a liquidity crisis on top, right? Where you actually can't get things to where they need to go. Right, with all the sanctions, it's hard to get fertilizers to where they need to go. It's hard to get your nat gas to where they need to go. So, all these things coming together, which I think is inherently so much more unpredictable. But, all signs point to a lot of these disruptions, when China does zero COVID or anything like that, right? It's probably not unreasonable to expect things to go back to normal very quickly. And I think that's the main thing that makes forecasting inflation so challenging right now. If you're purely demand-led, you probably feel more comfortable. But I think we're leaning more towards the camp that, there's a lot of further supply disruption probably coming. For example, like if you look at semis, right, like it's such a hyper globalized, super efficient process. Things are going to cross over borders like hundreds of times, if not thousands of times, right, before you components and things get their final spot. So again, it just seems extremely naive to think that we can just go back to doing things the way they were. Like a really good factoid, I can't remember what I heard this, but I love using it. The US still has sanctions on Cuba today, right? That just gives you a sense of how long ramifications from potentially this Russia-Ukraine war and the disruptions could go. So I think that's probably the main issue and why it's been so challenging for everyone to forecast inflation correctly.
Well, with August, the numbers coming in hot, obviously the plateau forecast is looking a little more prescient than the rapid return to 2% or close to it that break evens and things seem to be pointing to. I think it also points to the fact that many people are just looking at the cyclical. And they're maybe missing some of the structural drivers of inflation. You mentioned kind of a commodity super cycle. There's, demographic issues that, Goodhart and Pradhan's book, I've just plugged in probably every podcast I've done because I think it's so important. The demographic component, the deglobalization component, which, some people appreciate, some people dismiss kind of out of hand. If you're paying attention to just the cyclical and not the structural, you might be, missing a really important part of the picture as well. How do you guys, balance those two things, the cyclical versus the structural?
It's hard, right? I think we don't have a exactly quantified way of doing it. I think we're essentially looking at our cyclical models, looking at some of the structural indicators, but also just, reading a lot about kind of history, from something we plug all the time is kind of Bernholz's book on hyperinflations, right? That, for example, is the most extreme. But we also track kind of global developments. Things like there's not, for example, in the West, no one really talks about how important China's 5-year plans are. So if China's previous 5-year plans were all about flooding global markets with cheap widgets, right, that they're willing to sell at a loss, they're willing to manufacture at a huge cost to their own environment, then that's why you've had durable goods deflation in the world for so long. But now China's 5-year plans have changed, right? They don't want to do that anymore, right? So there's a lot of these kind of shifts that I think just helps us color a little bit the way things are going, and then obviously on top of that that helps you kind of bias a little bit of the cyclical. But I would say, though, in particular, if you want to focusing on this month and last month's CPI print and the data, the rule of thumb way would be to really try and break inflation down into kind of essentially 4 pieces, right? You essentially have housing, you essentially have goods, you essentially have services, and then you have food and energy, right? You can just bucket it together as kind of one piece, really. And so I think, at least seeing a lot of the new stuff, I think there tends to be often just too much focus on kind of one bucket as if that's going to solve everything. Because again, historically, goods have just trended, right? And services, again, move slowly. So it's not being an issue. But what you're seeing right now is very divergent moves across these 4 different buckets, right? Goods inflation is for sure rolling over because it's very hard to sustain the kind of extreme inflation from previously. As demand slows down a little bit, as the rest of the world is in recession, and clearly, supply chains ease up a little bit, not necessarily fully, but they ease up a little bit. That goods inflation can come off. However, service inflation is picking up, right? There's some concerns about wage price spiral. Wage growth is peaking, but again, it's not coming off, so that's why it leans more towards the plateau idea. If you look at housing, the housing component remains very strong. This is something I think we were a bit wrong on, where we thought that there would be a catch up in housing CPI originally because of the distortions to the data during the pandemic, the eviction moratoriums, the issues with the delays in collecting the data. To us, we thought that would, roughly have fallen out essentially, the last month and this month. But what you also saw at the same time was just asking rents kept surging, right? So this was the piece where, we thought that it would normalize, but if you're, that the base effects were kicking a little bit, but because asking rents keep going higher, it's kind of also getting dragged higher. So, that's why it's a pretty mixed picture. And overall, everyone seems very focused on just where, gasoline prices are. And, obviously that's been coming off. So people think inflation is fine, but in terms of the underlying trend for kind of core services, underlying trend for housing, these are actually still going. And ultimately, I think that's why, the data is being somewhat of a surprise, and maybe why the market has reacted so negatively now to this number.
Well, yeah, in asking you about, balancing the cyclical and structural components, I was in the back of my mind thinking about the commodities space. You sent me a research piece today that I haven't had the chance to really dig into, titled "Lessons from Commodity History," Part 2. what are the investment implications, I guess, in terms of balancing cyclical versus structural, right? If we're still in a commodity super cycle, but there's cyclical headwinds to the bull case, I guess, how do you look at that and kind of put those two things together, I guess, balance them in terms of the investment analysis?
So, well, I mean, the short answer would be it depends on how you think about your kind of core portfolio allocations versus maybe a tactical book, or if you're able to trade options, maybe doing overlays. But I guess in terms of, if let's assume you're only going to be long only, right, or just buy only, then I think it comes back to how much your fundamental structural thesis is still holding up. Ultimately, when we think about structural investment thesis, a key part of it is this idea of the capital cycle. Again, we didn't invent this. The best book on the capital cycle was kind of Marathon Asset Management, and then your previous guest and chancellor wrote the book on it, Capital Returns. And so the key idea in terms of, if you're looking 3 years out, is within any capitalist system, in theory, money should move to kind of the highest, marginal returns, right, and away from kind of the lowest marginal returns area. But the way this tends to work is that things tend to overshoot. So a particular industry will get very sexy, loads of money go in, generate a bunch of momentum and, self-reinforcing loops, and it just kind of overshoots. But then eventually the marginal return comes off because there's too much new money in a certain area, there's too much competition, it reduces future profit potential. And then suddenly, there's a crash and the money has to come back out and go to kind of areas economy where it's capital scarce. And obviously, we've just lived through a decade of, consumer tech, right, being the prime example, just sucking all the capital in at the expense of kind of hardware, manufacturing, anything with like a big capex footprint, right? Because, it looks like such low return business, low tangible return business, nobody wants to touch it. So, that's kind of the context. So when you look at commodity industries, and in particular, we're very focused on energy, it's kind of the area that's lacked investment for so long. And then things like ESG and all these things that come along on top to completely restrict capital going into the sector. And so as of right now, there's still very minimal kind of responses in terms of energy companies actually wanting to invest more, right, or try to increase production. And so because at heart, that core piece hasn't changed, I think that still makes us structurally very bullish. And then it's just a case of maybe dialing down the risk slightly, depending on how concerned you are about the cyclical risk. But even there, I would say we're fairly relaxed still, right? I mean, we will probably be happy to ride through the drawdowns a bit. Obviously, our US recession model hasn't exactly triggered, but just bear in mind, right? If this is going to be a commodity-induced recession, then historically you've had recessions where commodities can rally through, right? You've had, 73, 1980. These are commodity-driven recessions, and so commodities actually do fine because actually the rest of the economy is forced to adjust, right? It's the economy leads to inflation, forces down purchasing power everywhere else, and all the other sectors suffer. And it's not unreasonable to think that something like that could potentially be set up this time around as well, even if you were to balance the cyclical and the structural. So, to us, I think the risk very much remains to the upside in terms of energy because it's just so inelastic and there's just a lot of disruption potential. Not obviously, it'll be very volatile, but structurally, that's kind of where we are. We do attempt to try and correct for the demand side, but again, if beyond like some of our more tactical or high frequency trading clients or people with like a fairly tight drawdown limit, broadly, I think we're not too concerned. But if you only have, say, a 1 to 2 month horizon where you need to worry about your drawdown on that horizon, then I do think right now it is probably worth dialing down the risk a bit and just wait to see the kind of recession signal go off, wait to see the Fed kind of hike us into a recession, and then after that, for things to kind of wash through the system and eventually policymakers start easing, and that'll be a point at which to kind of reestablish kind of the long again.
Yeah, I think it's, there's some recency bias involved too in people's ideas of recession, right? In the last two, right, the COVID recession, we saw nominal growth decline pretty significantly for a short period of time. 2008-9, we saw nominal growth go negative also. But if you look back to the 70s, last time, inflation was a problem, we had, 3 recessions from 1969 to 84 or something, 4 recessions technically. And nominal growth never fell below 3%. For most of the time, even during the 74 recession, nominal growth stayed at 7-8%. And so it's like you can have the economy growing nominally at pretty strong levels. But, so I guess that it kind of goes to, I guess, it contradicts people's idea of what recession means when inflation is running as high as it is today.
Yeah, absolutely. Ultimately, there's very few things that are brand new, and history does rhyme. So even the COVID recession, right, that was a pretty good historical analog to kind of 1927 recession, which was kind of, a very similar, policy-driven recession, right? Obviously, COVID was just lockdowns everywhere. But in 27, it was, Henry Ford shutting down his factories to switch from building the Model T to the Model A. But because, Ford was such a big part of the economy, it was all the kind of linked, like subsidiary or linked services or the downstream. Yeah, it actually caused a huge shock to the system. So, with all these things, you can find actually some historical guidance. And I think the problem for today is given the just how bad the structural supply deficit, at least to us looks, and how little of a response you've had, it seems more likely it's going to fit into kind of these commodity-induced, right? So it's either going to be a commodity-induced recession, or it's just the policymakers would really have to be very, preemptive and completely trying to destroy demand before that kicks in, right? Either way, it's not particularly good.
Yeah. Well, we have to get to your market bottom checklist, because this is something you sent me a couple of months ago, and I've never seen something. It seems like every research firm kind of puts out one of these. You see the big sell side firms put them out, but they maybe have 10 things on them, and yours is the most exhaustive one I've ever seen. It's fascinating. How did this project come about, first of all?
So. As I said earlier, this idea of man plus machine, I think to us, that doesn't just mean take any data input and trying to, fit models to it. I think it also means being very empirical in our approach, essentially evidence-based. So, the idea originally was to, try and find all the situations of what market bottoms actually look like, right? Both through inflationary periods and deflationary periods, and see if there's any common themes that came out of it. Because, as you said, right, there's a lot of information out there and everything sounds intuitive. And we were just curious, again, in real time, what could you have observed? And is it actually trackable, right? Is it just a finger in the air? A lot of these things you typically hear about market bottoms, people say sentiment's really bad, right? It's not precisely defined. So I think we really wanted to go back and figure out, is there a cleaner way to define things that is evidence-based? That also means then, going forward, we can have a reasonable symbol for it. So that was kind of the original idea. And I think we've been working on this variously over the history of the firm. And obviously we've gone for a few more kind of, major crashes and market bottoms since we started doing this. And so, typically there are a few kind of common themes that tend to come out. And I think the most important, as I put right up front, is it's extremely rare for markets to bottom without kind of policy easing, right? Not just backing off from hikes, but monetary policy is actually being eased, right? That there is a slowdown in progress, and policymakers are worried. I think Michael Hartner at BAML has a great line on this where he says, markets stop panicking when policymakers start panicking, right? Which is, I guess, another way of saying this. But, that's for example, a very common theme. So, if, say, the market's already bottomed this time around and this is the beginning of the bull, it would literally be one of the first times that policymakers haven't panicked, and yet the market's bottom, right? So there's a lot of these examples where, we have data going back to the 66 bottom. So, at this point, it's probably 10, something like that. So, yeah, you can get a good sense of what does this make sense.
Yeah.
And, yeah.
Well, I was just going to say, it's a really great point about, policymakers, because one of the bullet points you have on your checklist is Fed easing for at least 6 to 12 months. I think many people seem to think that market bottoms coincide with a pivot, kind of like they did in 2018. But that example is more of the exception to the rule than what you typically see in bear markets, which is, during the dot-com bust, right? Fed was easing for a long period of time before stocks bottomed. Same thing in the financial crisis. And so people are looking to any sign for the potential the Fed's going to back off, as that might be a sign for the stock market to bottom. But that might not be the case.
Yeah, I think this Fed pivot sensitivity is only really being a more recent kind of decade situation, and often it's because it's happened kind of without a broad-based economy-wide recession, right? So obviously in 18, the pivot worked pretty quickly. Obviously, when it was Bernanke and they were trying, in the kind of the original QE2, QE3, Draghi, whatever it takes, right? I think these things are very prominent in investors' minds, which is why I think there's the sense that, as soon as you get a pivot, there'll be follow through, and then the market responds. But ultimately, I think the issue is most of these things have come against a backdrop of actually still okay liquidity conditions, certainly not so much inflation, right? Like all these things essentially happened during the low inflation era where stock bonds were positively correlated, and then also, so even if you were fully invested going in, on the sell of your bonds probably did rally, so you could switch some of that out. You have some ammo to buy in the market, and the market goes back up, right? I think the big challenge today is there's been nowhere to hide, right? Bonds are down, equities are down. If you're a vol trader, vol has monetized pretty poorly this year, right? And obviously, it's a synchronized global hiking cycle that's pushed most of our liquidity indicators down to kind of 30-year plus lows. And by the way, they've been there for a while, right? And they started collapsing basically from fourth quarter last year already. So that's kind of more the context in which we're trying to think about this bear market, right? So this is much more of a bear market that fits into a genuine kind of recessionary market crash that you mentioned that we see historically, rather than just a short-term phenomenon, like a 2018 style kind of quick one where the underlying, mechanisms haven't kind of fully broken, right? Where, there's still money to come in on the sidelines. I think the concern now is that liquidity conditions are probably so bad because, inflation, all these things are eating into it, that even if you pivot, you would need some kind of really, really major intervention before you actually generate enough excess liquidity to actually flow back into markets, right? It seems to me the main argument right now for the bull case is essentially there'll be a short squeeze of people are pretty underweight, right? That's kind of the argument, or that sentiment is too bearish. But I think if you look at the global aggregate system in terms of money creation, that money doesn't necessarily have to go into the stock markets, right? Going to asset prices, right? That money can be used up by the real economy, can be used up in inflation. And right now, the issue is that the inflation in the real economy eating up a lot of it, such that there isn't any excess to support asset prices, and it looks like it could be a while before you generate positive excess liquidity again. So, I think that's the broader context why we are choosing to focusing on these kind of more lengthy, kind of historical bear markets.
Yeah, well, and I love that the checklist spans. It's got tactical components, cyclical, and structural. It encompasses all three, so that it kind of just demonstrates how you guys put these things together into a larger framework. You've written in the report that not enough of these have triggered yet to be confident about a major stock market bottom. So it's interesting to me to see how the tactical fit with some of the cyclical and other things, because you talk about, Fed needs to be easing. We also need to see that in the yield curve, right? You need to see the yield curve has been steepening for months. You need to see, like I mentioned before, that recession has actually been declared and the news is stale. But then, there's also tactical things like, long-term oversold, in terms of RSI and things. What are some of the things that, I guess maybe one or two of these things that you'd be most curious to see that would maybe really get you thinking like, okay, maybe we are closer to a bottom today?
Yeah, sure. in my mind, at least, I think the most important thing is that we see the bond market behave as it should at the bottom, which is you first get a bond rally on a recession scare. And then once it's obvious there's a recession, policymakers typically start easing. And then in response to easing, the yield curve actually steepens, right? So the rally reverses, but also the curve steepens. So generally, you should expect to see curve steepening, as you mentioned, in response to policy easing. At the same time, bonds should have a big risk-off recession scare rally first, and then that kind of unwinds. So that would be like a live market confirmation. On the economic side, I think it's really important to see consumer expectations relative to present conditions really start to pick up. We're seeing it a little bit right now on the Michigan surveys, but not so much on the conference board surveys. It's still probably in the range of just normal vol. I think the Michigan survey tends to be a bit more financial situation based, whereas the conference board has, I think, some more economic inputs. But ideally, you want to see that pick up, start to pick up a bit more, because we tend to observe things like that at the bottom ahead of time. So those are probably the main ones that I'm looking to see if there's been a shift. Otherwise, I think obviously the world's a bit different today, but certainly if our China area actually bottoms, that would actually be pretty helpful as a cyclical indicator. I think that the problem is our China indicator just keeps making new lows, as it has done for the whole of this year, right? And so without that, and obviously China's a big piece now as well, that's kind of going to be a problem. So mentally, I think our minds, the bond. I think if you just watch the bond markets, I'll give you a lot of useful information. Obviously, if going back to maybe the 84 analogy I mentioned earlier, what you saw back then was inflation actually peaked, and then the central banks told you that it's peaked, and then they tell you they are peak hawkish policy, right? And then bonds can start to and then yields basically can start coming off, right? And then equities can start rallying. And so, this year, we obviously the market keeps trying to front run it, but it's not easy to front run when there's been such a shift in kind of the environment. Even today, I think we're putting a really great quote from like the Bundesbanker from 1989, where they talked about how why they kept, even though it was German reunification, that in theory you need to support growth in East Germany, right? Support the rebuilding effort. The Bundesbank kept a pretty contractionary monetary policy, and they were just saying, that was a response to kind of environment where where you had years of easy liquidity, right? That's led to kind of lots of excesses, and the currencies being weak, and they're going to start importing inflation. And so it's important to kind of get a hold of that first and maintain credibility. And that seems to be more where the world we're at today, right? Central banks, certainly developed market central banks, the history, history rhymes, but it's never exactly the same. But I'm sure today's central bankers know all about the history of loss of credibility in EM central banks, right? All the 70s. Right. I'm fairly sure none of them want a repeat of that. So, inflation credibility is probably quite high up. And also today's central banks probably talk to each other a lot more than they did historically. In 16, there were the rumors of Shanghai Accord. In the financial crisis, we saw, these joint swap lines where, the Fed was obviously giving dollar swap lines to the other DM central banks. There's probably more of a concerted attempt to really establish policy credibility than people think, right? So until they reestablish that, there probably isn't going to be much of easing. And without it, it would not fit the historical pattern in terms of what a genuine market bottom looks like. Now, this doesn't mean we necessarily have to crash another 50%, right? It could just be equity markets just stuck here and we just trade sideways for a while, and there's just lots of headline risk. That could happen. But so the way I think about using this is trying to tell me when I can very aggressively buy and then sleep at night for the next 2 years, right? Mm-hmm. When I'm happy to be like basically full max long and not worry about it too much. And so, with these missing pieces, I'll be pretty uncomfortable just going a max long here.
Right. Well, yeah, and a sideways market, would be still a kind of out of line with bear market precedents. You have a slide in your latest piece that you sent me about bear markets consistently show an acceleration into the final sell-off, and it's that kind of a move that would inspire panic in the sense, in monetary policy, a major shift that would actually probably get people, buying bonds again. See the long end come down. That would be required to see kind of a typical bear market low that would be in line with history.
Yeah. I mean, again, what we try and do is do empirical research, and and again, most of the time you should expect to see an acceleration. So if it's missing this time, it would be quite rare.
Yeah. Well, I really thank you for taking the time to do this, Tian. It's been fascinating to dig into your research for the past few years, and a real pleasure to be able to take you, to pick your mind about a lot of this stuff. It's especially relevant to what's going on in the markets today. And I think, if you are a passive investor, you're missing, you're absolutely just ignoring a lot of these things that potentially represent paradigm shifts across markets and economies. Setting all that stuff aside, I'm curious to know, do you have any hobbies or interests outside of the markets that maybe have made you a better investor or have informed your work in any way?
Although I mean this answer is given quite a lot, but I think just reading a lot. Also, again, I think ultimately, I think maybe the reason we're all ultimately, once you get into finance investing, you stick to it is, maybe this is Charlie Munger again, right? Like knowledge is cumulative in finance, and so the more you read, the more you learn, and then the more they compound upon each other, and eventually, you know stuff across a broad swath of things that. You can start to kind of connect the dots and see the picture. So, yeah, I think reading, these days, obviously, we're calling podcasts. There's a lot of great kind of podcasts out there as well, just across tons of things that could be relevant to ultimately how you make an investing decision, right? Like, podcasts like Founders, and a lot of these are really, really high quality, right? Where he's essentially reading the book and then telling you about it. So, yeah, I think reading a lot and just being genuinely curious probably has helped a lot to try and come up with some of these connect the dot type things.
Well, that's, was one of the inspirations for this podcast was, the art of worldly wisdom comes from Charlie Munger. And obviously he's an avid reader and has been an advocate for kind of putting together, taking various disciplines and using them to kind of inform your work in whatever your primary work is. So I absolutely and am in support of that and applaud that. Tian, before I let you go, where can people keep up with you and your ideas?
Sure. So, variantperception.com is the main website. We have a blog. We're on Twitter. We don't tend to probably get into any kind of the Twitter fights or anything like that, but we'll try and post charts we think are interesting. And on our blog, we'll try and share a few kind of themes or framework ideas. And I think for institutional investors, family office and the like, obviously we provide a kind of full service kind of product in terms of selling research, but also data, consulting work, providing data feeds, providing indicators, and the like. So, that's kind of the what pays the bills. But, I think it's important for us as well just to, share with the world our philosophy. So, you can find us on, as I mentioned, go to the website and you can take it from there.
Well, I'm a huge fan. I've been following the Twitter feed and the blog for a very long time. I recommend everybody check it out because it's just, you guys put up on a regular basis very valuable information. So, Tian, thank you so much for taking the time to do this. I'm really grateful to you.
No, like Jesse, I've been a big fan of your work. So, yeah, absolutely very happy to come on and, look forward to staying connected in the future.
Sound on it for the 142!
And that does it for another episode of Super Investors and the Art of Worldly Wisdom. As always, you can find notes and links related to this episode at thefelderreport.com. Thank you for listening, and until next time, buy low, sell high.
Man looks in the abyss. There's nothing staring back at him. At that moment, man finds his character. And that is what keeps him out of the abyss.